everyone. I see Miss Tammy. Hello. Bobby, who never works. Hello. Heidi. Hello. We got a few folks that'll still be coming on, hopefully. Tammy and let's see, we got Tammy. We're missing Marcia and Ben. Okay. Well, we're going to go ahead and get started and introduce everybody, and they can get on when they free up. So this is the first week of our home buying series. It's a 3-part series. I'm going over the loan process. I'm going over the process with the realtor, and of course the legal process as it relates to home purchase. And we have Day Air Credit Union's one and only Don Schweitzer, who is a part of the business development department at Day Air Credit Union. And we have Josh Todd and Miss Page, who are in our mortgage department. So they will be telling you all about the loan process.
But we're in kind of an unusual real estate market where interest rates are trending upward long term, and the prices are also trending upward. There's not a lot of inventory, so there are more people wanting to buy our so it's definitely so I would like to, with that, open it up to questions from all of you. So without further ado, let me share my screen here. Why wouldn't we do PowerPoint, right? All right, let me see what that looks like. Oh, good, I went over to the side. And maybe I will. Yeah, we'll do the animation because it shows up. All right, anyway, our agenda is essentially the process that as we see it as the mortgage lender. What you do before you even think about buying, and then what you do during that process, and a little bit about key points after you're done. Because there are some key points that a lot of folks don't realize, maybe we don't communicate it well enough, or they forget that comes up later. So we'll start with the process. I made an arrow. This has been revised a couple of times. It was way too bright. My wife told me it was too bright, but so we have a left side, the beginning, before you even think about buying. It's really credit and savings are the two things you need to work on. We've done this before in front of like Fairmont High School, for example, and for the high school kids who they're farther away from buying. I hate to say it this way, but dumb it down to credit and savings. Those are the two things you work on in advance. And when you think you're ready, and you are ready, you have money and credit enough, you visit someone like Paige, a loan officer, and then she will pre-approve you. And you'll find a realtor and you'll go look for a house, which is the fun part, as long as it doesn't drag on too long. And then you'll find your dream home, so you think, and you'll enter into a contract. And once you enter into a contract, you enter our green zone here, where we process the loan. There's some disclosures up front. We order some services like appraisal, and then that takes a couple of weeks. And then an underwriter looks at it and picks it apart. My background's underwriting. The underwriters are pessimists, right? And all the loans are going bad, right? But and then we clear the loan to close. Then there's a waiting period. You get your cash to close ready. We send you a disclosure. You get your insurance done, and then you go to the signing day and sign this big old stack of papers, about 3/4 of an inch thick. I feel like you're signing your life away.
You are.
Yeah, you kind of are. Then we enter the blue house that's tipped on the side, the end of the arrow, where we have a servicing team. They put the loans in our system and take care of you from then on out. So that's a really high level view of the process. All right, so the getting ready part, again, it's as simple as credit and savings. One of the first questions that folks ask you when they call in or you call them is, what credit score do I need? The answer, you hear this a lot at Day Air, it depends. Kind of depends on the product that you're looking for, but generally speaking, 620 will get you into that proverbial ballpark. So here's a snip from our system. I'm talking with my hands too much. It's in the camera. There's a snip from our system where when we pull credit, we pull 3 credit bureaus and we take the middle score. Typically, if there are 2 borrowers, it'll be whoever's lower and the middle score there, and that will be the score that generally qualifies you. Now there's this exception with some loans where they'll average it, but for the most part, think 620. Obviously, the higher the better, but 620 will get you in the ballpark. Think about younger folks you may talk to who maybe just out of high school, just out of college, and they are thinking about buying a home someday, as most folks do. They want to pay any bill. Not every bill reports to the credit bureau, but something like car insurance, utility bill, it's one of those things. If you're not able to pay or you don't pay for some reason, it can get to your credit bureau. But usually you see there's nothing there. That kind of indicates you're paying those pretty well. The next thing you'll need is some money. With most loan products, you'll need money for down payment, something called closing costs, prepaids, reserves, and we'll define those in more detail later. But the last thing, you move into a new house, there's nothing in it. So you might need to buy some stuff. Buy a couch, a bed. Paige bought a house a couple years ago, and she had to go buy a bunch of stuff.
Yep.
Yeah. So you need some dough, if you will.
Fix some stuff.
Yeah. I always say that too. 2 things are going to break within the first 30 days. I guarantee it. Mine, it was the air conditioner and the garbage disposal.
Yeah.
When we moved in July. So that was fantastic. All right, next. You think you're there? We're into that green zone. No, this is the yellow zone. The yellow zone. I shouldn't have done the arrow thing, but I did. So the die is cast. In the yellow zone, hey, I'm ready to go. What do? You want to get pre-approved. So you reach out to a loan officer, and someone like Paige would take an application from you, pull credit, look at your income and assets, and get an idea of what you qualify for. I'll throw a note in here. There was an old stat, and I have not seen this stat updated in a number of years, and it was probably a fake statistic anyway. But roughly 2/3 of folks who want to buy a house, they go to a realtor first. And then the realtor says, are you pre-approved? No. And then the realtor, well, you need to go get pre-approved. And sometimes they ask, oh, who should I go to? And well, you can go to this bank or this credit union. But typically you will need to be pre-approved first, because a seller, if any of you haven't sold a home, the seller is not going to accept your offer unless the seller has a good idea that you can pay for the house. And most of us don't have 150, 200 grand sitting around to buy a house. So we typically need a mortgage. And that pre-approval letter is what they're looking for. Right here, I'd like to distinguish pre-approval versus pre-qualified. So if Paige talks to you, your credit looks pretty good, your income sounds pretty good, your assets, your money for your down payment sounds pretty good. You look pre-qualified. But what we like to do is take a look at some income and asset information to get an idea that you really make that much money, or that it's going to conform to how the underwriter is going to calculate that income, because there's some gray in there. And same thing with the funds for closing. So we don't send you in blind. An example of that might be somebody who's self-employed borrower. Hey, I make 90,000. Well, when you get income information, you realize that that's 90,000 of revenues, and they write it down to like 20,000. So we like to try to make sure we know what your income is going in, so you don't spend earnest money, which we'll talk about in a second, and lose that when you enter a contract. Pre-approvals are generally good for 120 days from the day we pull it. And our loan officers, unless we're super busy like 2020, keep up and say, hey, how's the search going? And they'll reach out and say, hey man, your credit's about due to expire. All right. So the search, this is where you need a realtor. I recommend using a realtor because they understand the contract. They know how to find homes. They will, a good realtor will ask you what you're looking for, where you want to live, what kind of price range, and find properties for you. And then you go do the fun part, which is look for house. Now, I guess market is kind of weird. Not a lot of inventory or houses for sale. So some borrowers, some of our members that they've got pre-approved a year or two ago, they're still looking. Just haven't found anything suitable. What are you experiencing on that?
I would say 9 times out of 10, they're still struggling to find exactly what they're looking for. So the realtors are really helpful also because if something's previously been noted wrong on an inspection, the realtor is helpful in telling you, so you're not wasting your time going to see houses that you don't want to actually put an offer in on. And I would say we're definitely seeing less availability.
And so that's why I said the search is fun, unless it goes on too long. Some folks, I'm getting sick and tired of going looking at houses and open houses. There's a open house fine. So they give up and then, okay, it's been 6 months or a year and I'm ready to go again. But generally it's fun. I think I looked at 3 or 4 houses before we put in an offer and we won. But when you find one you like, the realtor helps you put in a bid, and your pre-approval letter is part of that bid. Hey, you have this house listed for 160. I'm bidding 165. And pre-approval goes with it, and that seller knows that you can get financing. Next is, I won't go into too much depth here. My animation was backwards, so I'll go ahead and put those up. Because we'll have a realtor talk more about the contract, but you will enter into, it's, what is it, 11 pages now? It's a lengthy contract. It's a purchase agreement, and it spells out the sales price that you agreed to, when you're going to close, and any other conditions, like are they leaving the stove, are you buying the ping pong table? That's atypical, but an example like that. And you'll sign that and get that over to Paige and drive on, move forward. So the last part is the earnest money. It's the first part where you're spending some money. Earnest money is like a good faith deposit. It indicates you're serious. It's usually 500 or 1,000. In today's market, I've seen earnest money 5,000. I've seen higher amounts. So sometimes you get into a bidding war and seller has 5 offers to look at and they pick one. But the earnest money says I'm serious. And that is important because if most people don't have 80,000 of cash sitting around. They usually have what they need to buy the house. And if you put in a bid and say you put down $1,000 of earnest money and you can't close for some reason, or you don't close, you could lose that good faith deposit, because that's the seller is sacrificing time on getting the proceeds from the sale. So they in some cases can keep your earnest money.
Or a potential lost sale to another buyer because yours didn't close.
Correct. Absolutely correct. All right, so once that contract is signed, hopefully by now your loan officer knows who your realtor is. Sometimes you don't. But it's a little bit of a race. I think the lender has kind of the most difficult part of the home buying process in some ways, because we have to corral all these parties together to make a loan happen. But it starts with that contract, and it needs to get to the loan officer as quickly as possible, because you generally have 25, 30, 35 days. They're usually short contracts, I would say. There really is not quite enough time, so it's a rush to get everything done. So it's important that that contract goes to the loan officer immediately, because the loan officer has some work to do when we get the contract. Paige, how long would you say it takes you to convert an application, put in the address, and all that stuff once you get a contract?
Once we have the contract, on our side, I don't think it takes as long actually converting and disclosing the loan with the borrower. I think them getting into contract is what takes the longest. Once we receive the contract, it only takes a couple of minutes, in my opinion, to review everything, convert the application over, and then disclose the loan terms.
Yeah, so there's a little bit of work for the loan officer to do. Before we go to the next slide and order services, the page would give you a loan estimate that looks a little bit like this, that's on the screen. It'll give you the target loan amount, the interest rate, the estimated payment. There are subsequent pages with estimated closing costs. So you can get an idea. It's not precise. It's not intended to, it's not our mandate to be 100% precise, but we have to be somewhat precise or accurate. So you have an idea of what you're going to be signing for at the end. And along with that package, you'll get to sign a form called the intent to proceed. And that simply says, I'm ready to proceed with this loan. So drive on. So it's important to read the loan estimate to know what you're getting into, but it's also important to do it quickly so we can have a signed disclosure package, stuttering here, because that's needed to do anything like the title work and to order the appraisal. So that's processing part one. So Paige will hand off the application typically to a processor or an assistant who will order services. And what I mean by that are typically appraisal, title, flood. Sometimes there are some others that apply like a condo review, but they'll order those and they take some time to come back. I'll talk briefly about the top three, but an appraisal is essentially where you get your value. You send a trained appraiser out. They take pictures of the house, evaluate the condition of the property, and will consider other similar properties that are nearby that sold recently. And they'll validate that your sales price is in line with what the market value is. And again, that's an appraiser's opinion. Sometimes it's low, sometimes it's high. It's generally pretty close though. Realtors have a pretty good idea what something is worth. So it is more common lately for there to be short appraisals. But you know, it happens, not too often, but it's happening more with the market the way it is. Title is more Doug Savessi's beat, so I won't talk it too much, but essentially title is finding clear ownership. Does the seller have the right to sell you this property? And will you, as the buyer, have a clear ownership of the property? And then we as the lender, we care too.
Yeah.
If you talk about, you're talking about John McManus being an engaging speaker talking about taxes, Doug is actually very good talking about title. That could be something that's probably dry to some people, but when he's talked this in the past, he's very engaging, much better than me. So if you're bored, better times are coming. Last one is flood, and that takes 5 seconds, but it tells us if you need flood insurance. If your property is in a flood zone, the federal government requires you to have flood insurance. In fact, they require us to make you have flood insurance. Most properties are not, but it's something that we need to do. Another thing that you might be asked for up front is anticipated loan conditions. Your processor and your loan officer, they are not underwriters, so that they're not going to pick you apart like the underwriter, but they will anticipate. They have a good idea on what the underwriter is going to ask for. So they'll ask you for a laundry list of documents at this time typically. And when you turn those in, we're hoping that that's most of what you'll need, knowing that when you get later in the process, it's likely that an underwriter is going to ask you for some other documentation. And sometimes that documentation begets other documentation. For example, if you need a fresh bank statement and there's something called a large deposit on it, they want to make sure you didn't borrow extra money. Maybe count that in the liabilities. So it's a little bit on documentation. Next, we go to underwriting, where you get somebody like me who thinks everybody's going to not pay us back and we're all going to go out of business. I'm exaggerating for effect, of course, but the underwriter just, at this point, the underwriter's not saying yes or no, we're making the loan. A loan officer has kind of done that. The underwriter is trying to make it work, giving a final evaluation of your income, your assets. They'll review the appraisal to make sure the condition is good and that the value makes sense. And also review title to make sure that you have clear ownership of that property when we close. Ordinarily, when you go into underwriting, you'll be approved with conditions, and the underwriter will ask for a few items that are typically routine. It's normally an insurance is one that's always on there. But once you get those back, you'll be cleared to close. And that's the victory. That's when Paige gets to call you and say, hey, we're cleared to close. When do you want to close? And all those sorts of things. So that's the moment of victory. There's usually some angst when we're in underwriting, because you never know. Yeah, I don't know, depending on the type of loan and underwriter, sometimes stuff comes out of left field, but we're usually pretty good at getting through underwriting pretty quickly. Oh yeah, approved. Forgot my animation. So once you're closed, you don't just go to closing. There is a little bit of a waiting period. We have to issue you this closing disclosure that you see on the screen, very similar to the loan estimate with a little more detail. It will have the final loan amount, the interest rate you're paying, the payment you're going to pay, and the closing costs you're going to pay. So it dials it in from the estimate to the CD, we call it a CD, closing disclosure, what you're going to actually sign for. And you need to have that 3 days in advance of closing. So there's a little bit of a waiting period. And the reason for that is the law wants you to have time to really consider and look at this loan estimate to know what you're signing for. Two other things you'll need to work on is you'll be told to bind your insurance. And what that means is that you probably got a homeowner's insurance quote from an agent when you started the process. Now you need to go back to that agent and say, hey, whatever your name is, I'm ready to finalize an insurance policy. And they need a date for that insurance to start. So that's why in this period of time, it's a little bit of a race. So the borrower really needs to get on that and get that policy signed so it can be factored into this closing disclosure. The last thing you'll get, if you look at the bottom of that screen, this one, I think this is a fake one. Yeah, this one, no, is it? Yeah, it doesn't matter. I think it's a fake one. But in this case, the cash to close was $108,000. So you will also have to, whatever your cash to close is, have to arrange for that to get sent to the title company. And it's normally wired. If a member has it, we wire it with our loan proceeds. So that's your pre-closing period. That's usually 3 or 4 days, sometimes 6 or 7. But it's a little bit of a race at that point. But you're almost done. So here's an example of a cash to close. So say you bought a house for $176,000. It's a real example. So the loan amount is $177,20, and this borrower put down 3%, so that's $52.80. So that borrower at least needed that much. Then we're not going to go through these fees per se, but if you look at that figure at the bottom, the $27.15, those are the total closing costs. So that's another $27.15 the borrower might need. Then we fund something called an escrow account. It's at the bottom of this page. I can't see that figure because of but it's like $3,000. There's another amount of prepaids to fund the escrow. And I can explain what that is in a second. So that in total is as much as $11,418.05 that this particular borrower could need for cash to close. Now there are, this one had like some seller paid closing costs, and sometimes you get a grant and that lowers that cash to close. And sometimes we have something called a tolerance cure where we disclose that, say, an appraisal was going to cost $450 and ended up costing $500. We might have to eat that $50. So we give you the $50 credit toward closing costs. So this is a little bit of an illustration on how the cash to close works and what goes into it. Then you go to closing, sign that big old thick stack. It's probably 3/4 of an inch, I think I'd say. There might be 17 or 18 documents you sign. And there is an agent from the title company there who will walk you through those and answer your questions on those loan documents. They're pretty standard, so any title agent can probably answer any question pertaining to the closing documents. Loan officers, we typically like to go to the closing on a purchase to share that joy of you're done with you, but and also sometimes the loan officers can help answer questions. Then you get your keys and you think it's all over. Congratulations. But now you own the house. But that's the moment of victory. We get to the finish line. I'm not going to lie to you and say a mortgage process is fun. It's a project, and they never go 100% according to plan, or they rarely do. So when you get to the end, there's immense relief. And then if it's your first home, there's victory, or it's your dream home and you're moving up to a bigger home or to a new area you wanted to move to. It's really a gratifying moment. And that's kind of what we as a lender get out of mortgages, is that celebration, that bang at the end, like, yes, we did it. Yeah. So Apple closed, it's not over. I told you it's not over. So what Dayton will do, we have a small servicing team. There are 4 folks. They will put the loan in our system. And it's not immediate. It takes sometimes a week or 2. They'll send you a welcome letter. You'll set up auto pay or however you want to pay. Then moving forward, the credit union will pay your escrows. And what I mean is we'll pay your taxes and insurance. So I think I have an animation here, a cartoon. So here's an example of a total mortgage payment. And if any of you haven't had a mortgage before, but say you had a car loan, you have a car payment, whatever it is, and it's principal and interest. That's part of the payment, but there's the escrows. So there's a little bit added to the payment, stuttering here, for insurance, taxes, and if you have private mortgage insurance. So we call that the total PITI, or principal, interest, taxes, and insurance. There's an A on there too if you're a homeowners association, but we don't generally pay that. You'll pay us the PITI, and we will once a year pay your homeowners insurance, twice a year pay your taxes. Then if you have private mortgage insurance, we'll pay that once a month. The note I really wanted to make here, the point I wanted to make at the bottom, is that the PITI changes just about every year. Every year you run an analysis or required law, we have a handful of borrowers who say, hey, wait, I thought my payment wasn't supposed to change. Well, you may have a 15, 30-year fixed loan, something like that. The principal and interest portion does not change. However, the escrows, they tend to go up over time. You've heard that values are increasing. So what is Carl Keith doing downtown as the auditor? He's doing his job, reassessing your house, how much is it worth, and your tax bill goes up. The tax bill goes up, it also costs more to rebuild the house. So the homeowner's insurance goes up. So those figures do increase pretty much every year. You'll have exceptions, but they go up over time. So that's something to know going in. Occasionally I'll get a borrower who insists on something, say something like a $1,000 payment. That's great. You're going to get into the house with $1,000, but within 12 months, it's probably going to go up. Hopefully the borrower's income goes up too, but just know that it will increase over time. And hopefully that goes smoothly. You'll hear from us once a year with the escrow analysis, and then you pay, and that's that. And then someday you pay it off, and we give you a satisfaction mortgage, and you own your home free and clear, and that probably feels really good. I don't know what that feels like. All right, that's all we really had. Well, what questions do you have? I'm going to stop my share. And now you can see us. Sorry about that. I'm on camera again. Does anyone have anything they'd like to ask?
Come on, guys. I know somebody's got a question. Especially if you've never purchased a home before, this would be a great time to ask. And for those of you that are on this call that didn't know that, I used to work for Dayton Credit Union. So financial services is me. It's something I'm passionate about. Financial education specifically is something I'm very passionate about. And one thing that I would talk to the members about was being educated as a borrower before going into buying a home. There's a lot of things involved with purchasing a home, not just the purchasing, but over time, all the things that happen as a homeowner. And one thing I'm glad Josh brought up was the fluctuation in costs over time, with your payment. Your escrow is going to change. Like he said, your homeowner's insurance is not going to be the same for the whole 30 years that you have a mortgage. Your taxes are not the same for the entire time that you own your home. So there's going to be some fluctuation sometimes from year to year as those figures change, and you have to be aware that those things are happening. I've had clients who had mortgages and weren't paying attention to the changes in their escrow. They were getting statements from the mortgage company, but they weren't paying attention to them. They weren't responding accordingly. They weren't sending the adjusted amount for their mortgage. So I've seen people lose their homes because they're not educated on everything that can happen as a homeowner. This is your time to ask those questions, because these folks are a great resource, not only when it's time for you to buy your home, but to get you educated and thinking as a homeowner and get you prepared to buy. Miss Vicky is also on this call, Vicky Risch. She is the financial and housing counselor for MVCAP. She is a resource for you as well. She is your peer, and she's very knowledgeable. So even aside from what Dayer is offering, Vicky is also a great resource. So you can reach out to her with questions to help prepare you for the home buying process. So please use this opportunity to ask those questions. Anything you're curious about, it's not a dumb question, I promise you. You want to be as informed and prepared as possible for something such as this. It's a serious commitment. I always say this is as serious as a marriage. It's till death do you part, in sickness and in health. It is a long-term commitment. So you want to be prepared. Please ask questions, and do not be embarrassed or afraid that you think it's a silly question or a dumb question. That is what they're here for. That is why you're here in this workshop. Please get your questions answered while they're here and available.
Yeah, any question is a good question. We do this every day. So when you do something every day, you tend to speak in jargon that might not make sense to folks who don't do this every day. So any question you can ask or chat. I thought I
have a question for you.
Yeah, go ahead, Don.
Why can't I pay my own taxes and insurance?
Good question. Sometimes you can't. It depends, remember? So normally when you say you owe 80% or more of the value of the house, you're required to escrow. One, it's a good service for you, and two, as the lender, it's protection for us. Make sure the taxes are paid and that your house is insured. So once you pay down to 80%, you can ask to have that removed. Or if you refinance and you don't want to deal with escrow, you can do it yourself. But great question.
All right, I have another one then.
Okay.
All right, so I don't put 20% down, and you kind of mentioned this. There's another form of insurance I have to pay. Can you explain that a little bit?
Yes. So it's customary in the mortgage world, if you owe 80% or more, that you will have to pay private mortgage insurance. And that really insures us. It insures us in anything in excess of 80% generally. So that's in the off chance that you can't pay for some reason. Let's face it, life happens to people, and there are results in a foreclosure. We would have private mortgage insurance to kind of limit our losses. So it insures us, but you have to pay it. Sounds kind of unfair, but it's pretty customary over 80%.
Does that ever go away?
Yes. On most loan types, standard PMI drops off automatically at 78%. And that probably takes 6 or 7 years if you finance 95 or 97%. Or when you think you're at 80%, you can request to have that removed if we get a new appraisal. So great question.
Is that true on all loans, like government loans?
That's a great segue. Remember, it depends. There are different loan types where, yeah, it doesn't fall off. FHA is one. A lot of folks ask for FHA loans thinking, well, I have credit or income challenges, so I need an FHA. That's great. That's a great product. It has its advantages, but one of the disadvantages is that your PMI does not fall off. You pay it for the life. It does decline over time, but it's going to be there until the loan goes away. Dare has a product. I was going to talk about this if somebody asked about bringing so much, that 11 grand figure of cash to close. We do have a no money down product that doesn't have PMI, because we understand that not everybody has 11 grand sitting around. Sometimes you have some money, and sometimes we think it's better if you keep that money just in case something breaks.
All right, so Tammy has a Tammy C has a question. Is there a difference in procedure if you want to build a home?
Oh yeah. In reality, it's the same for Paige. She will key in an application with you and get you pre-approved. The added step is we have to go approve your builder if we haven't already approved the builder, and that's not that big of a deal, but it is a little bit of a process. Probably takes a week. And then when we close, you don't have a final loan because we haven't drawn anything out yet. You have a line of credit technically, and we control it. And as the builder builds the property after the foundation, they'll ask for some money. After they put up the sticks, they'll ask for some money, and so on until the loan's done. And then 6 or 9 months or however long it takes later, we'll make a new loan and pay off that line of credit. So it does look a little different. Great question.
So I have a question regarding, since you mentioned a new build, most new builds, when they initially start their loan, they're paying in their escrow for property taxes or land tax. And then eventually it transitions over to the property taxes. Does that ever get discussed at the beginning of the loan, or when there's the closing, or to whomever for the property, or for the lender, the person who's trying to own the property? Because I used to work for a mortgage company, and they would always act super surprised, like, well, my taxes, past year or two were super low, and you just hit me with this super high bill in my escrow, and I don't know what happened. And so of course,
yeah, we've seen it.
Starts.
Yeah, great question, April. What you're talking about is when you buy the land. So real estate's land. There's no house there, so the tax bill is pretty low. And when you finish, say it's 6 months, your tax bill's still low. We'll set up an escrow account, and then at the year mark, guess what? The county knows that there's a house there now, so now it's worth a lot more, and your tax bill jumps up. So that's happened even here before. When I first came to the mortgage department, I've been here 14 years and been in different departments, but 5 or 6 years ago, I looked at a case where that happened, and the borrower was surprised. So the fix that we've put in at the credit union, I can't speak to other lenders, is we assume when we go to the permanent loan after we're done building, that your tax bill is going to jump up. So we estimate 1.5% of the value, and we divide that by 12, and we make that the monthly portion of the escrow that goes in for taxes. And that should, if it's not, it won't be accurate, it won't be perfect, but it'll temper the blow. So you're paying $1,500 now, and then, oh golly, I got to pay $2,100 now because my tax bill came due. So we do account for that. Great question.
So then I have another question, and this may be just specific to me. So I've been trying to educate myself on which would be more beneficial, which would be like an FHA loan for a first-time owner, or a VA loan. Now, I do know that there are differences in how those loans are structured, but again, this is me trying to educate myself. So my question then is, how do you educate someone on where their starting point should be, other than going to talk to a bank about the loan process? Like, do you tell them start with, your credit, start with savings, start with, like, where do we, meaning I, start?
Sure. Yeah, if you're not sure where you are, it's as simple as finding out what the scores are, services that you can get with the reports and the scores. and we do a credit score enhancement in-house. You'll see a branch manager and they'll go through your credit and say, well, you're good enough, or maybe we need to fix a couple of things, give you some pointers. And then the savings, we have savings vehicles. They're accounts, I say vehicles, jargon, accounts that you can use to build up savings. That's kind of where we start. And then in terms of products, we usually let the loan officer take an application from you. And we usually have a product in mind, but the loan officer is trained to figure out what might be the best product for you. Or you may have 2 or 3 options. So you mentioned FHA, VA. Sometimes you qualify for a VA. Maybe you have a VA and you want to buy another property, so you can't get a VA. So you got to go FHA. That's where your loan officer is there to help and kind of give you the trade-offs of each product type. Did that answer your question? Okay, good question. I hope my answer was good. Yeah. What other questions?
So she mentioned the FHA and VA. What are the differences?
So those are essentially insurance funds. FHA is insured by the Department of Housing and Urban Development. So that's why you pay PMI. VA is insured by the VA. And they don't have a monthly PMI. They have what's called a funding fee up front for the veteran. I have a VA loan. And I had to pay a funding fee. And the funding fee is essentially a single premium mortgage insurance. But you don't have a monthly PMI premium. Some veterans, typically I say typically a lot, your disabled veterans will qualify to have that fee waived. So the VA is insuring that loan for them. And again, that insurance is there if something unforeseen happens and you can't pay the mortgage and there has to be a foreclosure. It insures the lender against some of the loss. Good question, Don.
Are there down payment differences?
Oh, yeah. Yeah, so FHA will require 3.5% down. VA, in theory, you can get into it with no down payment. I say no down payment, you can finance 100% of the loan amount, but you still may have to pay closing costs and prepaids and that funding fee. Actually, you can finance the funding fee typically. Good question. What else?
I think it's called, I'm pretty sure it's not called gap insurance, but I'm trying to remember what the name of it was, where in the unfortunate event that something happens to the lender, the loan is paid off. However, most insurance companies, like where you get your car or your renter's insurance, if you don't actually say the name, some of them are like, I don't know what that's called. Where do lenders go to get that, or what's the name of that? Because again, I cannot remember it.
Yeah, so what I think you're talking about is if, say, you have a car loan and you buy GAP, which protects you, it'll pay off your loan if your car depreciates in value the second you drive it off the lot. You get in an accident and you owe $25,000 on a car that's now worth $20,000. So you have a $5,000 deficit. We call that GAP insurance. I'm not really familiar with that kind of product for mortgages. I've had that as an idea, but I've not seen it in the market. In theory, it sounds like a great idea, but real estate, I don't think there's a big market for it because real estate tends to appreciate in value, whereas car pretty much always declines in value. So I'm not very familiar with those products if they exist out there in the market, unfortunately.
As a follow-up to that, do you think she also could be talking about credit life? Is that still offered, or credit disability for mortgages?
Gotcha, that's what you're talking about. It's not very common. Some mortgage lenders do, we don't, but it's not very common anymore. You probably will be able to find a lender out there who offers some credit life or disability insurance on a mortgage. It's just not that common.
I would also say that this is something we did. We didn't get credit life or disability, but we did when we bought our first home. We purchased an insurance policy just for that possible eventuality that if something happened to myself or something happened to my spouse, then the loan would have been paid off. So we actually went through our own insurance agent.
Mhm. What else? What other questions do we have?
And feel free to use the chat if you have a question. Hearing none,
Anybody else? I'm gonna call you out. Miss Marsha, Heidi, Ben, Shauna. Anybody? Bobby?
This was good information. Thank you.
Good,
Oh, pleasure.
good, good. I'm glad. I'm glad you were able to make it, Miss Marsha. Good.
Thank you.
This is much more fun than looking at loan documents. I can tell you that.
Yeah.
well, I believe next week we have Doug Sabesi from Martin Foligno, who's going to talk about the legal part. And then the last week is where we will have a realtor join us to talk about the process with a realtor.
Well, great. Well, thank you, Kathy, Don, and everybody for attending, putting this together. Again,
I
it's fun
appreciate you guys
looking
for
at loan
taking the
documents.
time, for sharing your wisdom. Oh, someone just asked a question. What are common mistakes for borrowers? I can tell you a couple. And maybe you guys will agree or say, no, that's wrong. Once you're pre-approved, you don't want to make any purchases on credit before you close on your home. So it would be very unwise to be pre-approved for a mortgage and then go out and buy a car. Or get pre-approved for a mortgage and go out and finance, $10,000 in furniture. You don't want to do that. You don't want to do that. Don't do that. Don't do that.
Right.
Yeah, I think that's probably number one. Number two is in tandem is I have 10 grand of assets and I spend some of it. Sometimes stuff happens, but any of that could, in theory, jeopardize your pre-approval.
Basically, anything that you go to the loan officer with that got you pre-approved, you showed your assets, your income, you don't want to change jobs where your income is going to fluctuate. That's new employment. You want to be very careful of making any life changes prior to closing your home. You want to take a job after closing, fantastic. You want to go buy that Ferrari, fantastic. Do it after you close on your mortgage. Don't do anything once you're pre-approved until you have signed your closing documents, and then you're done. Then you can go do whatever you want, as long as you can still pay your mortgage. Do whatever you want.
Quite
Don't
right.
do anything before that.
And kind of piggybacking off of that, if something happens, it's really important that you just keep your loan officer informed, because life happens to great
Right.
people.
Right.
Emergencies come up. You might have to spend your savings. But if we have that disclosed in the application and you're pre-approved based on those terms, we have to find a way to make it work. And the sooner we know, the better. So staying transparent throughout the entire process for the lender and the borrower is extremely important, so that everyone is on the same page. The more we know, the less mistakes we can make.
Right.
So I would say if something does happen, heaven forbid, make sure your loan officer is aware. If you have to spend, $3,000 on an emergency vet bill, or your car broke down, that's fine. Those things happen. We just need to know, and sooner than later. So avoiding at all possible borrowing funds. But if you have to, make sure to stay open with communication.
That
way we don't get to underwriting and it doesn't blow up at the end. So
right. That would include any use of your credit cards too. So if let's say you have no credit card balances, or your balances are at a certain point, you were pre-approved based on your credit usage at that point, you do not want to go back with $3,000 in new debt ran up on your credit cards before closing, because that can also be a whammy. That could be a game changer. So you want to be careful how you spend and how you use your other credit prior to closing on your mortgage.